For more on the market, obviously, we're joined this morning by Brian Nick, Nuveen's chief investment strategist, and David Lefkowitz, UBS executive director and equity strategist. Guys, good morning. Good to see you.
Good morning.
David, what is the mood on the street right now regarding this?
I think the mood is still taking it with a grain of salt. I think the agreement, or at least the discussion towards an agreement, does reduce some of the downside risks that the market had been worried about over the last several weeks. But it's clear, as we can see in the media reports, that there still is a lot of wood to chop before both sides find some real common ground and agree to a final document. So I think that means markets are going to continue to be kind of range bound and continue to be very sensitive to the developments that we see on the trade front.
Does it at the very least clear some brush for us to worry about other things? We got Brexit coming up in basically 2.5, 3 weeks.
And earnings season is just starting. So a lot of times at the end of the quarter, you see the markets turn their attention to something that isn't as fundamentally based, like are these tariffs going to go into effect or are they not? And now we'll start to see these earnings numbers come in for a quarter that we know was marked by a lot of volatility, a lot of trade-related news, most of it bad, an inverted yield curve. So a lot of worrisome signs of what we should start to expect from these companies.
Could we see another repeat of Q2 in the sense that you see all the estimates come down for earnings, it's really downbeat, and then there's a surprise to the upside?
That's our expectation. You saw that a little bit in Q1, especially in Q2, and we've seen the pretty aggressive downward revisions to both Q3 and Q4. We think we maybe eke out sort of a slightly positive year-on-year growth number, even though the estimates coming in are in a -3 to -4% range.
But David, it's a commentary that matters, and in the second quarter, according to Bank of America Merrill Lynch, 17% of S&P 500 companies mentioned tariffs as negative headwinds. Now, that number's got to be higher in this quarter. Got to be.
Yeah, I think so. I mean, it's clear the trade issues are still front and center. But I think also, importantly, we've seen some of the business sentiment indicators have weakened as well. The ISM manufacturing, ISM non-manufacturing indices are down. And that does suggest that the upside surprises are likely to be a little bit more muted than what we saw in the first half of the year. Now, I don't think we're going to see a big fall in earnings relative to expectations, but it still does mean that the headwinds that the global economy has been facing looks like they intensified a bit in the quarter, and that's going to be reflected, I think, in the commentary.
So what's the risk to reward then? I mean, with the markets just a couple percentage points off of record highs, I mean, is there a lot more upside compared to the potential downside that comes from, a trade deal that doesn't necessarily happen, or earnings season that doesn't necessarily come through?
Yeah, I think the risk reward is more balanced. I mean, I think you still have this kind of decelerating global economy. At the same time, markets are sort of braced for that. But I think what we don't really fully understand is if there are some how big the downside risks are from trade. And at any point, if we start to see business confidence begin to really deteriorate, that could start to weigh more negatively on the environment. And I would say the last thing is that looking at valuations, the market's trading at a PE multiple that's basically in line with its 5-year average. So markets look kind of fairly valued. At the same time, you still have sort of this downward momentum. We're looking for markets to continue to be range bound in that kind of environment.
Upsides. Buybacks had a pretty good Q3, right? Up relative to last year's Q3. Well, the Fed's going to be buying stuff through Q2. So how much is that worth?
Yeah, the Fed's going to be helpful. I think it's probably more helpful than we expected. If you look at the housing market, it's been a big source of upward surprises in the data during the third quarter. We'll see if that translates to better housing-related earnings for the third quarter as well. So it's not just the consumer anymore. We think this is going to be the first quarter of GDP growth. Talking about the third quarter, where residential investment actually adds to GDP growth since back in 2016. So
I was going to say, how many quarters now has it been a drag?
I think it's 7 or 8.
Yeah. That'll be interesting.
Yeah.
Of course, they always say housing punches above its weight. How much can it really do for the broader economy?
Yeah, it's going to be, this consumer is going to be the story, the make or break story. We know the consumer probably decelerated a little bit in the third quarter. The other thing keeping an eye on this morning is the import data from China was really bad. It's about 8% lower import growth this point versus the last year this time. That means that China is probably growing a lot more slowly than it's even reporting. And it's not just about trade. It's also going to be affecting Germany's economy. It's going to be affecting the rest of Europe. It's going to be affecting our economy too. And whether or not we strike a trade deal with China in the next couple of weeks, China's economy has been weakening for a long time.
David, but when you look at that, when you look at China data, some of the other data from other major markets around the globe, when you look at all the geopolitics that's playing out right now as well, is the U.S. still the best place for investors to be putting their money?
Yeah, we actually think it is. We're overweight the U.S. versus relative to other regions, and the U.S. tends to be a little bit more defensive relative to some of the other parts of the global equity market. On top of that, fundamentals are a little bit better here in the U.S. relative to other parts of the world, and the trade issues have really weighed more on business sentiment and actual earnings in other parts of the world. So we like the U.S. relative to what we see in terms of the opportunity set in emerging markets and non-U.S. developed markets.
So, Brian, is the way for an investor to be thinking about this right now, given all of the uncertainties and question marks, about preserving wealth or about actually being able to realize greater gains?
We're trying to do both at the same time. So we upgraded some of the more defensive parts of the bond market in our asset allocation this quarter, but we also are sticking to generally a risk-on stance. We still like U.S. growth stocks the best in the world, so similar to David's view. But we also upgraded non-U.S. developed simply because the valuations were just so low coming into the quarter, and we think if there's going to be any kind of a balance or optimism about the trade war, that will help Europe as much, if not more, than it will help the United States.
What's defensive in the bond market?
Longer duration, higher quality.
Okay.
Yeah.
All right, guys, we got a lot being thrown at us this week. We're just getting started. Brian, David, thanks, guys.
Thank you.